Tom here, FlipAnythingUSA. So on my channel, I show how I made my fortune in real estate, starting at 19 years old, millionaire by 28, and that's been almost 40 years ago. Today we're going to talk about Stephan. He had gotten a grade, basically, from Kevin O'Leary, Mr. Wonderful, who's actually my favorite shark, actually. So we're going to get to that next. We're going to watch this video together, but what I want to say about this is, look, Stephan, real sharp young man. You know, he was a real estate agent, turned YouTuber, made a pile of money in YouTube, and obviously it far exceeded any money he'd ever make as a real estate agent. You know, he did begin to buy real estate, and which is a smart thing to do, and he did, and he bought some things. Well, he had Mr. Wonderful here, or Kevin O'Leary, analyze his assets, and in the end, Kevin gave him a 6.5 on 10, so really like a 65%. That would be a D. It'd actually be like a D minus here. But the fact is, there's a great lesson here that I want to share with everyone. I think it's really important. One of the things that gets lost, real estate, a lot of people get lost in the numbers. So what you're going to see is he goes through a series of properties. In these properties, Graham's got these cards. Each of these represent the six properties that Graham has outside of his home that he owns. And Mr. Wonderful goes through these things, or Kevin O'Leary goes through these things. I'm so used to thinking of him as Mr. Wonderful. This is really going to be a great lesson. So let's watch this video together, and we're going to watch it in a little bit of high speed. There's no reason not to. You can understand it. It'll burn some time. Time is money. So we'll go through this real quickly. We'll watch it together. So let's go.
So I want you to react to something.
Sure.
I have my entire portfolio worth a little bit over $10 million.
Yeah.
So I want you to go through one by one. Just give me your
These are
thoughts
individual
on it.
stocks?
No, this is everything. This is real estate.
Okay.
This is every single one of my investments.
Got it.
So I want you to look through this.
Okay, so this is a piece of property, number one, purchased in 2012. 59,000 cash, 12,000 rent out of pocket 71, rent 14,000. So this is a good investment.
That was unfortunately a cash deal.
The whole thing
was a cash deal. I was all in 71,500.
You couldn't get credit at that time?
Right. I didn't have a credit card.
Right.
So no bank wanted to give a 21-year-old a loan because I had no credit history.
Okay, so right there is an important lesson, and I tell every millennial, even though I don't endorse credit cards, it's very hard to advance your credit rating without having one. So it's good to get a credit card, put maybe a $1,000 limit on it, and then start paying off, use $200 a month and pay it off every month. So I told my son, as soon as you get one, Trevor, put $50 on the card and pay it off. And now he's got a pristine credit rating, and he's only ever put a few $1,000 through the card. Everybody should understand that. There's no way to game that system. You've got to establish a credit rating, or you can't borrow. Property 2.
So, I want to say something about the credit cards. My first credit card I got in 1984, because it still says that on it. It's an American Express. In 1984, I was 22 years old. And the fact that it was an American Express, it's a wonderful first credit card to have. Okay, first of all, it's one of the easiest ones to get because it's only credit for a month. Okay, when you have an American Express, whatever you put on that card, you owe it all at the end of the month. So it's a really great way to train you to not overspend or spend more than you can afford, because so many people get in credit card debt, it's ridiculous. It's one of the saddest things ever is I see people that finally make the leap and buy a piece of property, they hold it for 5 or 10 years, and then they've accumulated so much consumptive debt, cars, boats, and junk, that they end up refinancing their house and getting rid of all their equity to pay this consumptive debt. So I don't like credit cards, particularly if you don't have discipline, but an American Express card is a great way to develop discipline in the very beginning. So let's keep watching.
Purchase 2012, cash again, 72,000, 8,000 renovation. Okay, so now you're 80,000 in the hole. Rent 1,200 a month, net 900 after costs, right?
Yep.
Another $280,000 because the market is appreciated.
Yes.
You're putting up a lot of your net worth at that time.
That was everything. I sold my car at the time so I can go buy real estate.
Yeah, I get it. Okay, property 3, purchase 2012.
Okay, so what's interesting on those first 2 properties, those were ones that I think are actually before he really had a YouTube channel going, and it was when money was precious, right? It's a lot tighter. He was successful as a real estate agent. He made some big commissions. Smart young man. I mean, he put his money away, had his priorities right, and he was hungry for that real estate. He made those purchases, and you could see, I think he paid 60 for one, 70 for the other, and now they're worth like $280,000. And at that time, they were probably worth about $40,000 more than he paid for them back then. I'm a little bit familiar with the area where he's at and with the kind of the crises that we were having at that time. But so he did really, really well. And now we're going to go on to his next investments here. And what you'll see is something that's typical with people. The easier the money comes to you, the less careful you are with making investments. You don't make as good of investments in general. People start making more money. They tend to, and it's to be honest, it's something that when you're rich, you can afford to do. The richer you are, the easier it is you can afford to make less on your money. In other words, if you got enough money, you can live on 5%, right? If you don't, then you got to make bigger gains. And that's what I teach you how to do in my book and my mentorship is how to make money. It's very difficult to just buy one asset and just sit and wait for it to go up. But that is something you can do when you make $1 million a year or $500,000 a year. But let's keep watching.
Well, again,
Same thing.
125,000.
Right.
Okay, that's a serious chunk of
So
change.
I used 4 years of savings to buy these. I
So
saved
you're still not
everything.
using any leverage in debt?
Nothing.
Okay, well, that's remarkable. 15,000 reno on top of that.
Yeah.
So now you're out of pocket 140,000. That's a little nerve-wracking.
Yeah.
Rent 21.45 per month after cost 1,500. Worth 400,000 today. So that's a really significant bump.
Yeah.
But you've got to admit you've benefited from the appreciation of this one asset class, real estate, as interest rates went down.
Correct.
So there is an inherent risk of concentration here. Your entire net worth is only in real estate so far.
Yep.
Okay, that's an issue. Property 4, purchase 2016. 780,000. You must have used that.
I did.
60,000 reno on top of it. Out of pocket 210,000. That's your principal down payment.
So let me just point out something here, and I'm going to get to this later. Look at what he's got here. He's got $2,100 a month coming in. So he's got $840,000. Whether he's got it invested partially cash of his own and or borrowed money. But look at he's getting $2,100 on an $800,000 asset, $2,100 a month rent. But if you go back just a little bit here, but you go back to his first property. Now look at his first property, paid $59,000, has $1,100 a month coming in. Okay, worth $280,000. Again, think about that. So he got $1,100 a month coming in on a property that he paid $60,000, and now he just bought another property. So that's where the numbers go wild and start going to pot. He paid nearly 10 times more, or he did pay 10 times more actually, for again just a little more than double the amount of rent.
Okay, that's good. That's also a great investment. But now we've brought leverage into the portfolio.
Yes. This is the one that you saw. This is the one that I was house hacking on that you thought was a good idea.
Yeah, 585, loan 620. Wait a sec, you borrowed more than the purchase price?
Because I did a cash out refinance.
Yeah.
So what I did is I fixed this place up. I put about right here $220,000 total in renovation.
Whoa.
So now
He's got an asset that's worth $1.2 million that's bringing in $5,500 a month. Okay, that's a lot better than the last, not as good as he did originally with his first purchase. So this is actually a pretty darn good investment that he's got here. Yeah. Comparatively. I still wouldn't work quite for me, but it's a lot better. But let's keep watching.
it was worth about $1,250, and I did a cash out refinance.
So what, it was a real junker, right?
Yeah.
Because that's a serious amount of change you're putting in.
Yeah, that one needed a lot of work.
So now you're using leverage and you're spending to invest, including adding more leverage.
Correct.
So what I like to start thinking about in terms of debt, particularly levered on real estate, or any investment, if the poo-poo hits the fan, and values go down across any asset class, including real estate, you still owe that $1 million.
Correct.
So you've got to start being sensitive to how much debt you want to bring into your world. A lot of people don't understand how debt can put you out of business if things go bad.
course.
You have to be ready to pay that $1 million off.
My thought has always been the interest rate is so low, fixed for 30 years, cash flow sustains it,
Yeah.
and between the write-offs and maybe inflation, maybe we don't see it, but either way, the worst case for me has always been a break even on the interest rate that I'm paying.
So, okay.
Yeah, see, break even isn't really going to work for most people that want to break. If you want to, listen, if you're trying to make money in real estate, and Graham has never sold any of his properties, so he's kind of in a different world. In other words, he's somebody that's like a doctor or a lawyer, and in other words, we makes really a lot of money, about $1 million a year last time I went from what he's described, and so most of us can't relate to making that, especially when you first start out in the beginning. Well, as it's an investment, I don't think it's a very good investment so far, but other than the very earliest ones he made. But let's keep watching.
Okay, we go on here.
Okay. So this is property number 6.
Yeah, 6
This is another duplex.
Everyone is going up.
Yes.
Like we're spending more,
Yes.
we're putting more debt on. This is $815,000 loan, $680. So there's a little equity from day one, right?
So let's take a look at this. $815,000. This investment is better than the last when I get to the chart.
Right.
3.65, very good. Down payment, $115,000, worth $965.
Yep.
Okay, so that's good.
And all of these, by the way, are rented under market value.
I get it.
Okay.
How long are the leases for?
1 year.
And so do you get to bump it up?
I don't raise rents, believe it or not.
What?
Yeah, see, now that's a mistake. And this is why, because you don't raise rents, what happens is that you take investments that were good in the beginning, that, like he had a high net return, he had a high return based on what he paid for it, But as the value goes up on the property, the income comes down, and then the asset really becomes, not a very attractive asset. That's why I tell people you always have to consider what something's worth when you're holding it. Even if it goes up a lot since you bought it, you have to compare it to what it brings in, because then you have to ask yourself, would I buy it? Now, and we'll get into that in a minute too, but a lot of these properties, again, I wouldn't buy them for the rent that he brings in. And if you don't sell it, you're buying it. So anyhow, we'll get to that in a sec.
Yeah.
Really? Why not?
My thought is if I have a really good tenant who always pays on time and no issues, I would rather just not raise the rent and keep them there.
Now listen, I do that too. I keep my rents under market, but never. Do I never raise rent? No, I raise rent every time the lease comes up. We'll raise the rent a little bit, but certainly good tenants, I keep them a little bit under market because I don't want them to go. I keep them so that they're still paying less than they would have to pay for something comparable. But to never it's just kind of foolish, to be honest.
A long time, and if they do move out, then it's kind of like gravy to me because I'm able to rent it out for even more to the next tenant and then tell them they can stay there as long as they want at that price.
Yeah.
And for me, I've had some tenants now for 7 or 8 years.
But property 7 purchased $2.1 million. That's our number one on the hit parade, right? This is this year.
Yeah. So this is where I am living now.
Okay. Loan. This is your primary residence.
Yes.
That's why you got the 2.875 rate. Now at the end of this journey, what is your total debt nut across all the buildings?
About 2.9.
Okay. I'm just saying that would start to make me nervous. Just not because it isn't well invested. That's a big number. Like a lot of it. Can you take the hit if?
Yeah, this is the thing. When you've lived long enough, and Mr. Wonderful's probably the same age as me, you've seen downturns. You've seen property values drop considerably. You've seen people lose jobs, not pay rent, move, etc. And like I say, the money shrivels up, and you got to have a backup plan. And I think he's like me. I just have very low debt now, but it's but you got to leverage a little bit in the beginning. But again, let's keep watching.
Just look at it that way.
Yeah.
Can you pay down, $3 million?
Yes.
As long as you can say yes to that, you can continue to do this. But the minute you get so levered up that you can't find $15 million, I don't have any debt. I've got to the point in my life where I just don't like debt. So I buy things for cash, and I understand why debt works in this model, assuming the rental market remains buoyant. But it comes a point in your life, and you're still too young. I don't want any obligation to anybody.
But don't you think that's because you already have so much money now that for you going and trying to borrow at 3% to make 5 might not be worth your time versus just the hassle-free of I'm going to buy it cash, not think about it.
Well, except because I'm older than you, I've seen a lot of things, and I've been through a lot of down cycles. Lots of my friends got wiped out. I mean, imagine being in your 40s and being wiped out, having to go bankrupt. Like that changes your life forever because you have that on your back. I would never want to wish that on anybody because it is a horrible thing to happen. And the only reason it happened to them is they didn't respect debt. You're being disciplined. You're buying assets that have income. They were buying boats and cars and watches and getting divorced. They loved their lifestyle. Yeah. They went to zero. You have to respect that, and you do. This makes sense to me. But again, I go back to that guy in New York, protein building, pasta building, and the whole idea of respecting how debt can rip your life apart. But so far, I don't see any crazy. You're not using debt to buy stupid stuff.
Right.
That's basically what's going on here.
All right. So this now is Sensor Video.
He's got a little bit more to go in terms of diversification. He wasn't a 10 because he didn't diversify enough.
Yeah. Well, I'm glad to see that because I never let one asset class ever become more than 20% of my net worth. Clearly, real estate still remains more than 20% of your net worth.
All right, so I'm going to cut it there. I'm just trying to keep this relevant to his real estate investment portfolio. This is getting into his home, which he must have a pretty sweet pad for $2.2 million, so good for him. But but that's not applicable to the real estate investment portfolio. I think he's got damn near $4 million in stocks and cash. So he's really got a nice chunk of cash, so he can bail himself out of trouble. All right, so we're going to talk about cap rate. Let's just look at this first one, right? So his first one, if we figure the cap rate on this thing, go to right here. See what you do is you take your net operating income. So you take NOI over your, in this case, let's do it first. We're going to do it over his cost. So NOI over his cost, okay, in this case. The other calculation is doing it over value, okay? So first what we'll do, we've got 1,100, okay? We're going to take that times 12, because that would be the income for a year, which is 13,200. And then we're going to divide it by the 59,500. Let me get my calculator going here. So we're going to take the $13,200. Okay, that's a year of income, and we're going to divide that by 59,500. Okay, now look at that. Look at that number. That's a 22, just a barely better than a 22%. When he bought it, he had a 22% cap rate. Okay, that's outstanding. Okay, now he's holding it, right? So this is how it changes. And now we take this figure, because this is what it's worth, and now we're going to put 280. And now we're going to do the same calculation. Now, keep an eye on the calculator here. 13,200 divided by $280,000. Now we're down to a 4.7. Okay. Now, I don't even think he has that much coming in, but maybe if it's net income, then that's what he's got after taxes. But you can see what's happened. Since 2012 to 2020, 8 years has passed. When he bought it, it was a fantastic deal. It was worth more than he was paying for it anyways, but he got a 22% cap rate. Now 8 years goes by, and now it's worth $280,000, okay? But he doesn't raise the rents. He's kind of diminishing the value of his asset. He's lowered his return by 5 times. He's getting 5 times less cap rate than he was getting when he started. So this is a big mistake that he's making right here. This is a mistake. He should be adjusting this up. I mean, if he just adjusted this $1,100 up to, maybe $2,000 a month, it should be worth $2,000 a month if it's $280. If it's worth $280,000, I mean, I wouldn't buy it if it didn't bring at least $2,000 a month rent. Even with interest rates as low as they are, maybe I might go. Maybe I'd accept $1,700. But again, you can see how this is such a great deal in the beginning. But after he's held it so long, now he's made it, again, not such an appealing asset. And that's the other thing. You got to do the math. At some point, you got to ask yourself, should I be holding on to stuff that I bought a long time ago? Well, he can sell this, and he'll have $280,000 cash to reinvest. Okay, he's going to have some taxes, of course, but, he could roll this in with a 1031, which is where you basically defer the taxes and you buy another piece of property. But he's not doing that. He's just sitting on here, and now he's basically getting, 4.7 on something he used to get a 22% return on, which he was probably not going to maintain that. It would be difficult to do. But again, this is a low return. Now let's go to his next property. He had $72,000, okay, was what he paid. And he has income 900 times 12. Yep, 10,800. So now he's got 10,800, and divide that by the 72,000. Okay, so 10,800 divided by 72,000. Okay, and look at that. He's got a 15% cap rate. Pretty darn good. Pretty darn good. And now let's do what it is based on today. That's when he bought it back in 2012. Now today, in 2020, 10,800 divided by 280,000. Now he's got like a 3.8. 3.8. And again, it's very similar. It's like 4 or 5 times less return. So his cap rate is now down quite a bit. We're back here, it was 15%. Now it's 3.8%. Again, he's kind of holding the asset too long. And the other thing that he's doing that's not a good move is he's not raising rents. If this thing's worth $280,000 again, he ought to be getting at least, $1,600 to $2,000 a month. If he did that, this would be significantly better. But again, now let's go take a look at one of the ones that he's bought even more recently. Okay, actually, so he paid $125. Renovations got $140. So let's do it by this number now, right? Oh, look at that rent. He breaks them down a little bit differently each time. Well, let's go ahead and do the math anyways. This is back in 2012 again, too. 1,500 times 12 to get our net operating income. So 1,500 times 12 sounds like 18,000. But first we'll do it over his 140. And let's do the math on that. 18,000 divided by 140. So not bad, 12.8. So, just about a 13% based on what he paid for it when he paid the 140. Back when he bought this thing originally, he had almost 13%. Today, we market to today's values, and things change quite a bit. So now this number is 400,000. Let's do the math, 18,000 divided by 400,000. Now he's down to a 4.5%. I wouldn't buy it for that, but it's compared to some of his portfolio. It's not too bad. But again, it's now again about a third of what it was when he bought it. Would you pay $400,000 to get 4.5%? I wouldn't. As you become wealthy, or when you are wealthy, is you can afford to make less on your money that's out there. But it's just fun to play with the numbers. It's important that you do. Here's property 4. He paid $780. He put $60 in it. That's $840. So based on what he paid for it, which is $840. So let's go ahead and do the math. But this time he's got a net income of $2,100. 2,100 times 12, 25,200. That represents his monthly income times 12 months. He's got 840 in it with his renovation and his cost itself. So here's 840. Do the math. 25,200 divided by 25.2 divided by 840,000. See, now look at that. See, now he's got a 3% return based on just what he's paid for it. He's got a 3% return based on the 840, 3%. That's a terrible cap rate, folks. It's terrible. Even the 4 and 5 is terrible to me. But you can see the richer he gets, he lowers his standards for having a profit. He lowers his standards a lot for having a profit. Let's go ahead and just take it to what it's worth today. Would I pay this much for it? Would I pay for $1,250,000 to get $2,100? The bottom line is, let's just do the math. Here's his rent, still 25. Let's do the $1,250,000. 25,200 divided by 125,000. Now he's getting a 2% return. This is a terrible return on what it's worth today. And even when he bought it, $840,000, a 3% return, I would have never bought that. And this is what Mr. Wonderful was talking about. He's gaining a lot of debt. He's getting a lot of debt for not much income. And you can say you have $600,000 equity, but maybe you don't, especially in a downturn. If you go in a downturn, then you really don't. So to me, this would be a much better asset if you can really sell it for $1,250,000, dump it. Your returns are terrible. Let's go to the next one. Property 5, let's see. Cost is $585. Renovation $220. Okay, so he's actually got some money in this thing. So $220 plus $585, $805,000. $805,000 on his purchase. His rent $5,500. Now he's not saying net income. He's just saying rent. He's not saying net income. Let's just take 1%. That'd be $1,000 a month. So let's just say $4,500. So this is probably really $4,500 because it just says rent. It's not accounting for taxes and maintenance and insurance, which is going to be more than 1%. But just to be, conservative to a degree, not be too harsh on it. So we'll say 4,500 times 12. So now he's got 54,100. I'm actually changing this to 4,500 because he says this is his rent. He didn't say it was his net income, and there's definitely $1,000 a month coming off this thing in taxes. So let's do the math. 54,000 divided by 805. With this deal that he got, look at the rent. He's getting this one. He's really, for as expensive a property this is, he's really getting some decent rent, right? So this one jumps up, just say 6.7%, right? But that's because he's got the rent. He's got the rents right. The rent's better. If we mark it to value of what today's value is, let's go ahead and do that exercise real quick. $1,250,000 in 54,000 divided by $1,250,000. Properties under $300,000 tend to bring in a lot higher cap rate than properties that are, say, over $300,000, especially when you get up to $1 million. So unless you're going to do an Airbnb, but that's a job. So when you take it to what it's worth today, it's 4.3. Okay, 6.7% is the value based on what he paid for it. Again, it's just a really important exercise. You got to pay attention to the numbers. And just so you know, I have an app called FlipAnything. You can get it for free. It's not on Android at this moment, but it's available free on iPhone. It has calculators in here that'll help you, that can make it easy to calculate quickly. But I urge you to get an amortization schedule and play with it because the numbers can make a tremendous amount of difference. And it's really just a good thing to study and play with. So let's go to the next investment. Okay, so here's property number 6. He paid $815. He did the same thing. He said rent, and he's not figuring in any taxes or maintenance. So this is really probably $3,900. I'm going to write $3,900. That would be net rent, just okay. I'm using it, trying to get to a fair net figure. So based on this, we got $3,900 times 12 months. So he's got $46,000 $4,800, and that's based on an $815,000 purchase. 15. And now this is a 5.7. When he bought it, he was getting 5.7%. Again, not something I'd buy, but it's certainly much better. But it doesn't compare to the 22% that he made on the first deal, and whatever the other one was. The following one after that was actually not too bad. I think it was 15%. Now you go by the value today, right? The 965. So we come in here, 965. Go to the calculator, and 46,800 divided by 965. So now he drops to 4.8%. Comes worth more, but his cash flow goes down. That's the bottom line. Because his taxes are going up too, don't forget. This is the problem with investing in residential property, to be quite honest. You can time it right, you can buy it, and you can get big gains in the value and the appreciation, but sometimes they'll go flat for a long time. Sometimes they'll drop quite a bit. Mr. O'Leary was getting at, and you got to be prepared to deal with that sort of thing. This is one of the reasons that the beauty of commercial, office, and industrial, those kinds of properties is that they're based on the income that they produce. They don't have the wild fluctuations. In fact, we'll go back to the gallery, play with this one. All right, so now let's take a look at the properties again. Let's start putting some of the numbers that we just went through. On property 1, and I'm doing this based on today's value right here. Just talking about the real estate portfolio now. Property 1, we have 4.7. That's the cap rate. 2 is 3.8. 3 is 4.5. 4 is a 2.0. And number 5 is 4.3. And number 6 is a 4.8. That is the cap rate on today's values of his portfolio. So you can see he's at a low of 2 and at a high of 4.8. I can do the average on this too, I suppose. But yeah, let's take a look at that. All right, so I made a chart here of the properties we just reviewed and the cap rates of each as I'd calculated them before. So you can see I've got each listed. So let's go ahead and add this stuff up. 280,000 plus 280 plus 280. Already did it. And plus let's see, another 400,000 plus 1,250,000 plus 1,250,000 plus 965,000. Okay, so we got a total here, 4,425,000. It's a nice number. Right, so he's got 425,000. Okay, so now let's go ahead and get the overall cap rate. And let's go ahead and get the overall cap rate on his whole portfolio. So we know his portfolio is worth 4,425,000. Okay, so look, I put a chart together here now. I have individual cap rates of each property there listed, written on there, based on the figures that we went through earlier. 4,425,000. That's the total value of his overall assets. Go ahead and add those, add the income up. 13,200 plus 10,800 plus 18,000 plus 25,200 plus 54,000 plus 46,800 plus. So we got 168,000 overall. That represents his rents, total income, net income that is. The total value of the real estate portfolio is 4,425,000. We've got 168,000 over the 4,425,000. And let's go ahead and do the math on that. 168,000, and we'll divide that by the 4,425,000. 168,000 divided by 4,425,000. So look, overall he's got a 3.8% return. He's got a 3.8 cap rate. So if he had everything paid for, he'd get 3.8%. That is not a very good return at all. In fact, the industry average, I would say, is roughly 7.25, 7, on what an average investor would expect. So I got to give Graham pretty much a D on this thing as well. He's getting about half the return he should on his overall portfolio, what it's worth. He still made some money. His earliest investments were obviously his best. He'd be better off to just go back and repeat history. Remember, he had 22% on that first one. He had 15% on the other one, but he held the one long enough. This one here originally was 22%. and now it's 4.7% cap rate. This one was 15% at one time. Now it's 3.8. So everything keeps going down when you market to value. That's the problem with residential with real estate. Also, he could be doing a better job. He doesn't raise his rents. If he raised his rents, he'd raise this number as well. But anyways, that's kind of interesting. But yeah, 3.8% return on your real estate profile is not particularly good at all. What is good though is that he did make some good buys early on that made some money. You're a great YouTuber. You make a lot of money, and you can support this kind of investing. And I don't mean to say that in a negative way. It's hard for it not to sound negative because it's not a very good investment. Look, Mr. Wonderful gave you 6.5. I'm pretty much giving you the same thing. Anyways, I like that this worked out. I appreciate your honesty, Graham. You really do share a lot about how you made your money, and your story's not too far different from my own in the beginning, being totally into real estate, and it's never stopped. All right, well, hey, I hope you enjoyed that. I enjoyed going through the numbers. Graham, thanks for being such an open book on your portfolio. And Mr. O'Leary, thank you for taking time to go through and share your knowledge as well. It really was an interesting exercise to go through and just to look at your portfolio. But I can tell you right now, you should be pushing this to double what it is, and you easily could. If I were you, I would just liquidate all this stuff and take your lumps on the taxes. You can reinvest it in stuff that's more stable and more profitable for long-term return. But anyways, that's it. I appreciate you watching, and till next time, thanks for hanging out.